cash and agrees to pay the remaining $200 premium next month.
Cash and accounts payable?
Well, partially. What else did he get?
Is this the double entry?
Well, they're all double entry, debits equal credits, but there may be more than one debit or more than one credit.
Well, I mean, this would be 4 entries for this, right?
Just 3.
Now,
What did he buy? He bought insurance, okay? So,
Oh, it's liability?
no. We use the term frequently, prepaid insurance. It means it's paid in advance. We'll try that one for now, right? What is that? That's the insurance policy I bought. That's an asset for my business. It protects me against liability claims or fire or whatever. An insurance policy is an asset. So I've got prepaid insurance, $400 worth. How did I pay for it?
cash?
$200 in cash. And?
Put the rest on accounts payable?
Good. I have an accounts payable, insurance for the balance. And somewhere I better make a note that on the end of next month I got to pay that insurance balance. You okay with that? Last entry that I've got here made up anyway. Sam pays his employee John $250 in salary. What's the first thing you know? What do you pay him? Cash. So you know the credit's going to be cash. How much was it? $250. And what kind of debit can we match up to that?
Salary.
Salary's what? Payable?
Expense.
Salary's expense when we incur it. So we'll call that salary's expense. And those are all the entries I made up for today. Just to give you the sense of every entry you look at, you're trying to figure out what do I debit, what do I credit. If you're really comfortable with what kind of different accounts out there, you'll find you use a lot of them a lot. You use a cash account every time you either receive or pay cash. Every time you sign a note for something, you have a notes payable. When you sign on account at your local supplier, you have an accounts payable. Every time you let a customer walk out your door owing you money, you've got an accounts receivable. Those are the ones you use most often. And then you're running through your mind, well, if I paid cash for something, what did I get in return? You got one of two things. You either bought an asset, maybe a truck, or you had an expense. Either one will have a debit entry. So when you credit cash, you know that's what's going on. Trying to think through those. Probably the best thing you do if you want to, continue to work on this is pick up any accounting book on the first chapter, and they'll have these kind of basic entries where you just get used to debit and credit, and debit and credit, and debit and credit. If you get that part down, and remembering what do you debit to increase it or decrease it, what do you credit to increase it or decrease it, when you get that down, the rest of accounting is really only two things. How do you put the books together at the end of the year to show how you did? And then, what about all these other more complicated transactions? What happens when I buy my inventory? What happens how do I calculate the cost of all the goods I sold? What do I do when people don't pay me, when I have a bad debt expense? Or somebody returns something from a sale. How do I journalize that? How do I record the depreciation on my truck? Because it loses value every year. Well, you got different chapters for those different topics, but if you know the basics of the journal entries, then it's just a case of figuring out what do I debit, what do I credit, what do I debit, what do I credit. Let's do a couple just for the practice of it. Suppose at the end of the year, remember that $10,000 truck I bought? Suppose I say that truck's got a life, it's going to last 5 years. And at the end of 5 years, it's going to be junk. I'm going to drive it into the dirt. it will be worth nothing. Then how much does that truck lose value every year over 5 years?
You paid $10,000 originally.
$10,000 cost divided by 5 years, it goes down $2,000 a year. That's one way to depreciate it. It's called straight line. Every year is the same amount. There's some other sophisticated ways to calculate it, double declining balance, some of the year's digits. You can learn those in the accounting textbooks, but the concept is what I'm after. At the end of the year, I look at my account and I say, truck, I bought it for $10,000. But at the end of the year, it's lost $2,000 in value. How do I enter that in my journal to make this account reflect the proper value? I say, I go to my journal and I say, on the end of the year, I had an expense called depreciation. Depreciation expense, $2,000. But what's the credit? And the credit should be a reduction in the truck's value, right? In a sense, you could write, oh, well, credit the truck for $2,000, it's a decrease in its value. But we don't do it that way. We keep a different account right behind the truck account, another contra account. And we call it accumulated depreciation. We'll spell that out. Accumulated depreciation on the truck, give it a credit for $2,000. So here I'm going to have a T account, accumulated depreciation on the truck. I'm going to make a $2,000 credit entry. So this is a contra asset account. It's a reduction in my initial asset account. You with me so far? So when I get ready to present my statements at the end of the year and tell my investors or whoever, here's how I'm doing, what's my truck worth? Only $8,000. And when I present that, somewhere in a statement or a balance sheet, I'm going to say truck, $10,000, less accumulated depreciation, $2,000, net truck's worth $8,000. Then I'll list the rest of my assets. Okay, so far? What happens at the end of the second year? I do the same entry again. This now has a $4,000 balance. So when I present my statements, I say truck, $10,000, accumulated depreciation has grown to $4,000, now my truck's only worth $6,000. These end of the year adjustments like this to your accounts are part of the nightmare of the accounting cycle. You spend the whole year making your debits and credit entries. That's the biggest challenge. Once you figure out those, at the end of the year, you've got to go through and make what they call adjusting and closing entries that clean up your accounts so they're reflecting exactly what's been going on. Once you've done those adjusting and closing entries, you do that on that trial balance. It's a nightmare sheet of coloring your paper. Then you prepare your statements, your income statement and your balance sheet.
So at the end of like next year, would that be 4,000 and then you add another 2, or would you have 2 entries for 2,000 and add another 2,000 entries?
No, at the end of the third year, I'd put 2 here. And when I made up my report, this would say 6. Good. Now, consideration here. What do we know about these expenses? They reduce my profit, don't they? But did I lose $2,000 in cash?
No.
No, this is a non-cash expense. I paid for the truck on the note and blah, 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 blah. This helps me reduce my taxable income, which reduces my taxes. After 5 years, my truck has no more depreciation expense left in it. It is fully depreciated. So I don't get any tax advantage from owning my truck. So what do I probably do with it? I'd probably sell it, trade it in, and get another asset that I can depreciate over time, assuming the business is healthy enough to afford that. Yeah. Okay? Would it help if I could depreciate my truck in 3 years instead of 5? I would have $3,333 in an expense each year. That would reduce my taxable income, right? So I would have lower taxes for 3 years, but then in 3 years, it's fully depreciated. For most businesses, if they're healthy and they can afford it, that's a great thing. The faster you can depreciate it, the more tax savings you can take right now. And therefore, you tend to replace your vehicles and equipment more frequently, which is healthy for the economy. And now the economist in me is talking to you, because that's what Ronald Reagan did. When he came into office, he offered us much more accelerated depreciation for tax purposes that tended to stimulate the economy. Sales of used vehicles picked up, sales of new vehicles picked up, because people got tax advantages through faster depreciation.
So I have two business questions.
Sure.
One, is there a table that the IRS gives us that says you can only allot so much, or do we determine that? Or is it based on mileage? Or?
There are different ways to do it. The IRS will tell you your options.
Okay. And the other one, in my mind, if I had a truck for $10,000 and it's depreciated, I would fully expect to sell it. But if I could, I would try every year to take $2,000 and put it in savings. So at the end of 5 years, I could buy another $10,000 truck. Does that complicate the books when you do that in a business? Or?
No. You can take $2,000 and probably in a subset of books that you keep personally, you can say, in my cash account, I got $42,000 and $2,000 of it I'm setting aside for trucking. You can do that.
Like a goal sheet or something.
Yeah.
Is that necessary, though, in a profitable business and just an average business?
If it's a profitable, viable, doing reasonably well business, why pay for cash unless interest rates are really high? Why not just buy it on time? Less cash out.
Possibly to get a better deal because you're paying cash from it.
Possibly, yeah. And so there's a lot of ins and outs. And when you get into depreciating buildings, the IRS has got schedules you've got to follow. And I'm way out of date on my IRS notes. I don't know how long the schedules are anymore. But if you're going to keep the books for your business and you're going to do the taxes for your business, you're going to spend many hours reading tax laws. And probably, unless you're stupid, you're going to have a tax accountant, or at least a CPA type accountant, who's going to give you advice on how to do that. Most small businesses, their accountant takes care of at least part of this. Usually the year-end stuff. Many businesses set up on QuickBooks, which is doing sort of the same thing. And then they take their QuickBook reports that the computer generates, take it to their accountant, who then figures out their taxes for them. So there's a division of labor there on what you're comfortable with.
I wish I brought in some questions, because I don't think the questions that we have initially in class are this simple. They're a lot more complicated right off the bat. And it's hard to visualize that without doing, I think, a lot of hours of this first to play with the accounts.
I think the most important thing you can do in the beginning is spend several hours journalizing and figuring out debits and credits and getting comfortable with what accounts are out there. Let's do one more just for illustration. You've got an account receivable from Strickland. He owes you money. He's been one of your customers buying on account. Okay? Will it have a credit balance or a debit balance? Have a debit balance. Strickland owes you $4,200. Okay? You've let him buy on credit, and he has been very slow in paying. In fact, he's never paid. In fact, he's been owing you this money for 7 years. Now, what does that say?
Don't lend them any more money.
It says that Strickland's a bum, but it says that you got really lousy collection procedures. Okay? So, what are you going to do about it? Well, practically speaking, in your business, you should have someone in your business who's very good on the telephone at collecting. In many, many small businesses, you'll see a husband and wife. Frequently, the wife is the one who's very good at getting on the phone and calling customers and saying, you owe us $1,700, you've owed us that for 4 months. When will I see a check? I need to see that check brought into my office by 4 o'clock tomorrow, or we turn this over to our accountant. And if you have to pay the small claims court fees, it's probably going to cost you $2,500. Now, are you going to be here tomorrow with that check or not? And somebody who's good at making those collections keeps this from happening very often. We used to teach surveyors about business management, and like many small service businesses, they're really bad, many of them, about collecting money like that. We used to say, if you'll give us all your accounts receivable over 6 months old, and let us keep 50% of the money we collect, we could retire. Because there was that much money outstanding that hadn't been collected. Not true of all businesses, but true of enough of them. And why can't people collect money from their customers?
They don't want to stir up bad will.
They're so afraid that if I really get mad at them, I'll lose them. And then they'll tell their friends and I'll lose them. Well, do you really want that person for a customer if they're not paying? And so you've heard, maybe you've heard the term, fire your customers. Some customers you want to fire. You don't want them for customers. Those kind, like Strickland. And I wouldn't hesitate to make them angry.
I think at the same time, if they like go tell their friends, you know, that you told them they have to pay, at the same time they could be telling their friends like, hey, I haven't paid this for 7 years and they haven't, you know, sent me anywhere. So then you can get more customers that come that want to try to.
You may get that, but if you start at the beginning, you don't let it get 7 years old. If they've got other deadbeat friends out there, those are the customers you don't want either.
Yeah, so I'm saying, go collect your money. Don't worry
Go
about
get
their
your money.
feelings.
Damn right. But suppose we looked at this and we said, well, we need to just write this one off. Strickland's never going to pay us. How do we do that?
An expense.
It's an expense. It's called a bad debt expense. So what would be your journal entry? What do you debit?
And the expense.
Bad debt expense. Yeah. You do a bad debt or uncollectible accounts. I like bad debts. Bad debts expense, $4,200. Accounts receivable Strickland. Credit, $4,200. That's another one of those kind of adjusting entries you would be making at the year's end, or maybe sometime during the year. Does this mean Strickland doesn't owe you with the money anymore? It just means that you don't think you're going to collect it. And by the way, what about that expense? That's a deduction from your income and reduces your taxes. In the meantime, you take the whole account, you turn it over to a collection agency or your attorney and let them go after it. Or you yourself go down to small claims and file a court on it.
That's what the lenders do. They actually sell all those, so you do wipe them off, and then
Yeah.
the
But
other company
my
collects.
point really is, do you see just the simplicity of the debit and the credit? It's not that complicated. So yes, you're right. These have been very simple entries. Nothing complicated.
Are we going to do any of the T account work, or?
Well, if you go back to the entries we just made, what typically would happen in your small business is maybe once a week, maybe once a month, depending on how busy you are, the bookkeeper, maybe you, is going to sit down with that journal, and every entry in the journal is going to be posted to the appropriate accounts. So, if we looked at the cash account, I know we had a $5,000 debit when he started the business. Remember that? And then, what other entries were there? We said he paid $3,000 for the equipment, so you post a $3,000 credit. Remember that one? He bought raw materials for $200, so we post that one. He took the guys to lunch and paid cash, we post that one. He bought the truck, he put $1,000 down on the truck, out of cash. And so we would keep posting all of these things until at the end of the month, or whenever we wanted to close the books, we'd look at that and say, what's the balance in the cash account? And here, what's the balance? $32, $33.50, $43.50. It should have a $650 balance just based on those entries. In every account, we would balance it out and say, what is the balance in the account? And we want to do that periodically just so we stay aware of what's going on. Now, what else about that $650 in the debit in the cash account? that better match my bank account. I want to reconcile my bank account, and it better be the same amount of money, because this is my bank account, my cash account that I operate in. Once I take the balance in every single T account, and can you see how laborious that would be if you had to do that one at a time? It's very rote. You're just moving this number from here to here. No real genius required, right? We could probably take a Florida State graduate and teach you to do that, okay? Maybe. But do you see then the joy of a computer? Man, it's just boom, it's done, okay? You don't even have time to go get a beer. Once you get all those accounts totaled, now you're ready to build that trial balance. And that's, you know, aside from having to hassle with journal entries, that's when your nightmares begin. The trial balance is going to take all of your accounts and show you their balances. And the total of debits better equal the total of credits. And if the computer did it, and every time you did a debit, you did a credit, and they matched, and everything you put in the journal went exactly into the ledger correctly, should be no problem. If you do it manually, trust me, Murphy will be at work and you'll screw it up. And your trial balance won't balance. But conceptually, what happens at the end is you run a trial balance for all your accounts. And then you go back and you say, what about all these adjustments I need to make at the end of the year, like this depreciation and all this stuff? You make those adjusting entries in your journal. And then you post them to the accounts. And now the accounts show you exactly how you're doing. Once you've got all those accounts showing exactly what happened in the business, you've got your assets, and you list all of those with their amounts, and then you list your liabilities, all of those with their amounts, and then you list your equity, one or two with their amounts, and these will be debits, and these will be credits, and these will balance, right? Assets equals liabilities plus equity. You'll present all of that, and that's your balance sheet. That's that photograph of your business. What do you got? How much you got, how much you owe, and net, how much you got. Okay, so far? That's pretty easy. Actually, then, not in this order, but let's go back and look at revenues and list those. Maybe we have 3 sources of revenue, and then list all of our expenses. You know, we've got 27 different expenses and their amounts. And revenues minus expenses equals what? Net income or profit, okay? And so when you show your net income, that's your income statement. And that's really where you start. You do that before the balance sheet. Okay? So suppose at the end of the year, Sam Adams does this, and he says, I made $50,000 in revenues, and I had $30,000 in expenses. What kind of year does Sam have?
Fair.
Pretty fair. Made $20,000 in the business. Okay. What do you do with that $20,000?
Invested in business.
Assuming he didn't take anything out for himself, no drawing. You know, he's independently wealthy, or his wife is supporting him, or whatever. And he says, I want to put all of that $20,000 profit, I want to put that back in the business. How does he do that? Where will it go?
Cash.
It will be reflected in the accumulation of cash over the year, and he will transfer it from profit into the capital account.
And that could be maybe purchasing more product or buying a new truck.
That's whatever he's going to do with it next year. Here's my point. At the end of the year, we do those adjusting entries, depreciation, bad debts, whatever. We get all our stuff right. We build our income statement. And then we're going to take all of the revenue accounts and all of the expense accounts, and we're going to transfer those amounts into this one account called income summary. And that is, in effect, that is our income statement. I take all of my revenue accounts, however many they are, all of my expense accounts, N of them, however many. And these will have a debit balance, what do we say, maybe $30,000 worth of debits, maybe $50,000 worth of credits. And at the end of the year, I create this temporary account called income summary. And I move these over there. How do I do that? How do I move this amount from here over to here? What's the journal entry? I want to zero
Debit
this.
revenue? No.
Yeah.
What
I'm
would
going
it
to
be?
debit revenue
And credit cash?
and credit income
income
summary.
summary.
For all of my revenues, $50,000. I'm going to do the same thing for expenses, except I'm going to credit expenses, debit income summary, $20,000, not $30,000. So what does my income summary account look like? It's got this for moving all these over there, and it's got $30,000 here for moving all of these over here.
Would that be flipped, the 30,000, would income summary be on top since it's the one being debited?
I'm sorry?
The second journal, would income summary be on top?
You're right, I got it backwards. Let's put that down correctly. Income summary is my debit. Expenses, I credit every expense account, one at a time, all the way until I get them all. And when I get them all posted over here, what's that income summary showing me? Shows me my profit for the year. Income minus expenses. And then I'm going to take that amount, $20,000 worth of income, and eventually I'm going to transfer that over into my drawing account. I'm sorry, my capital account, where I plowed it back into the business.
What kind of account is income summary?
I wouldn't call it any particular liability or equity, it's just a summary account. It's just a temporary account we open once to move everything together, and then we close it out when we move it to our
So it
capital.
carries a positive credit balance?
If you made money. If you lost money, you'll have a debit balance. So once again, journal entries, journal entries, journal entries, followed by adjusting entries, followed by this stuff called closing entries, and then you prepare your statements. Income statement and balance sheet. That's the simplest version of accounting I know how to tell you about. If you can keep that perspective, because my sense is what happens in accounting is so much information comes at you so quickly, you soon can't see the forest because there's too damn many trees. But if you can back off and keep it in perspective, every time they throw something at you, you can say, oh, I know where that goes up here. I know where that goes up here. And now I can manage, I can process this new data as it comes in. Oh, here's a new way to enter a journal transaction. Okay, well, it'll debit over here, it'll credit over there. And if you can keep that perspective, I think accounting is a lot easier. That's the heart and soul of what I really wanted to say today. I didn't know it would go this quick.
Can you review, just like an overview of, you start with the journal entry and then there's like 5 other steps, you know, forms or something that you have to do to complete? Do you know what I'm talking about? You do, I don't know.
Keep trying.
I didn't do well on that part. I wish I should have brought some material from the class. You don't have anything from class. Do you know what I'm talking about? You start with the journal, and then there's the ledger, and then there's
Then there's a trial balance.
trial balance, and then there's like 5. Isn't there 5? Oh, maybe.
From the trial balance, there is the income statement, sometimes an equity statement they have you get, and then a balance sheet.
Okay.
And equity just shows what? How much did your capital account grow and how much did you take out in drawing? When you get to a corporation, instead of capital and drawing accounts, these are equity, right? So this is increasing equity, this is decreasing equity. With a corporation, we're going to call this a combination of what you started with, the common stock. You buy stock in a company, that's your equity. And then the profits that you put back into the business, we're going to call retained earnings. So you have the initial investment plus the retained earnings. And then over here, the money paid out to the owners, you have an account called dividends.
Now, this is interesting. Based on what you just did, it's been an hour and 15 minutes. If 2001 class is the first two classes, we're practicing this, I think we'd have a better run after that point.
It could be, and it could be that they assign you all of this in those first 2 weeks, and you're supposed to spend 52 hours at it.
Well,
At the
you
end
do
of
have
which time you're
homework,
ready to go.
but you don't really put it together. It's just like, oh, I've got to get the homework done, and you don't relate the homework to the picture that you just painted.
I think that's true.
By what you just did, you painted a complete picture, and then the class could be then broken apart more detailed.
Yeah.
You know, I had a wonderful professor. I mean, she's very clear, very good, but very quick, and has to be very quick. But I think if first two classes were like this, we could be quicker further. And
Well, if this sort of thing helps and people get this kind of, watch this video or whatever and walk into class with that framework, then hallelujah, we all hit a
or
home
this
run.
video, that would be great.
I'm going to post this to YouTube.
I'm going to be practicing for the next week, a couple of hours at least.
Well, it puts things in perspective, but there is no other substitution in doing hundreds of journal entries to get comfortable with what do I debit, what do I credit.
This is the only answer why so many people with so many different backgrounds are crash and burning in accounting. You know?
Well, one is you don't have the perspective coming into it, and two is there is so much to cover.
Right.
Now think about this, accounting 2021 is accounting 1 and accounting 2 in one term. You can imagine what the attrition rate is like there. That's why I encourage everybody to take it in
So,
2 separate courses.
1 and 11 I thought equaled 30, 24. Did I get those classes wrong?
No, 2001 and 2011 equal 2021. 2021, or 01 and 11, plus managerial equals 3024. So 3024 is huge.
That's what she's going into.
You're getting ready to take 3024. You will find the first part of the course, which is the financial accounting that we're talking about here, you're going to be very comfortable with, I think, because you've had 2001. The second half of 3024, as it's constructed right now, is primarily managerial accounting, which if you've not had managerial accounting, is just a real fun dance. I'm being very cynical.
So would you recommend taking managerial, could you take managerial accounting?
You could, and you would be much better prepared for 3024.
Because I haven't signed the classes, but that's my next class to take. So.
Yeah, I think you would probably be well advised to talk to Dr. Hoover about that. He would certainly know more than I do about whether managerial accounting would be a good preparation, or whether in fact he's just going to teach it again, so why take it twice? I don't know.
As far as required, if accounting is not our strong point or something we're easily going to accomplish in, what 2 classes, because we have to take 2 accounting classes, right?
You have to take 2001 and 3024.
That's what I thought.
Yeah. And let me say this about the OM, Organizational Management Program overall. We're not really trying to teach you to be accountants, even though it may seem like it sometimes. We're not trying to teach you to be marketing experts or management experts. We're trying to teach you to be comfortable entering into that environment and talking about those issues and concepts. Not necessarily with all the detail, but so you can interface with your accountant and say, I've been looking at the balance sheet, and this will come from the finance course. Been looking at the balance sheet, and I see that our payables relative to our sales are growing every month. Is there a problem in our collections? That's what we want you to be able to identify. Don't want you to be making journal entries. I want you to be able to talk to that bookkeeper and ask about what's in there. I'm not an accountant. This is all the accounting I know.